So today in Accounting for Business Decisions A, course code 22107, we're going to look at master budget. Let's firstly look at what is a budget. A budget is an estimation of income and expenditure for a given amount of time. Budget can be used by an individual, group, organization, country, society, business, basically anything that generates and spends money. Budgeting creates a plan and estimation of how money is spent and used. So we have talked about what a budget is, but what's a master budget? So, a master budget consists of an interrelated set of budgets prepared by a business. The purpose of a master budget summarizes planned activities of different units or subsections of an organization. Within a master budget, there's two kinds of budgets. There's the operating budget and then there's the financial budget. So firstly, let's look at the operating budget. The operating budget is used to plan for the short term, typically a year or less. It shows income generating activities like revenues and expenses. The result of an operating budget is like a budgeted income statement. Operating budget needs to be planned first, as information within the operating budget is required to create the financial budget. Then there is the financial budget. The financial budget shows the inflows and outflows of cash and other relating elements to the firm's financial position. That inflow and outflow comes from the cash budget. The result of a financial budget is a budgeted balance sheet. By now, we should have a slight understanding of what the master budget is. Within the master budget, there are 7 steps, which I like to call them, and now I'll show you what they are individually. Step 1 is the sales budget. The sales budget is the starting point in the preparation of production budget for manufacturing companies and purchase budgets for merchandising companies. They are used in planning cash needs for a company. It is an estimate of the amount of units of a product a business is expected to sell multiplied by the expected sale price per unit. This will work out the sales budget. Step 2 is the production budget. The company will need to work out an estimation on the budget for how many units that company is required to produce in order to meet the sales budget the company had made. Step 3 includes working out the material purchase budget, the direct labor budget, and the manufacturing overhead budget. The material purchase budget is generated to show the raw materials needed in order to produce a desired amount as stated in Step 2, the production budget. Then there's the labor budget. The labor budget is generated to show the estimate of direct labors and other labor costs related to the production. And lastly, there is the manufacturing overhead budget. This is generated to estimate all other production costs other than the two mentioned before. Then there is Step 4, the cash budget. The cash budget shows the inflows and outflows, expected borrowings, and expected investings of a company. Information from various operating budgets will affect the cash budget estimated. Step 5 is selling and administrative expense budget. The cash budget is the starting point for this. The selling and administrative expense budget accounts for all operating costs and other production costs. Step 6 is working out the budgeted income statement. The budgeted income statement consists of budget for sales, cost for goods sold and selling, and administrative expense combined with data on other income, other expenses, and other income tax that are used to prepare the budget income statement. Lastly, Step 7 is the projected balance sheet. This is an estimation of the ending balance of all balance sheet accounts. With the estimations, it assumes that all operating and financial budgets are met. This may be used by managers in high positions in the company to assist with decisions in regards to the budgeting sales and costs which impact the company's financial conditions. So in the end, why would you use a master budget? Well, it compels communication to occur within an organization, forces management to have a plan for future goals, helps find financial problems before they become huge, defines specific goals and objectives for the organization, and the budgeting process can increase the coordination of organization activities and help facilitate goal congruence.